What's up, traders? I'm Hotshot. I am not an educator. My educator is ICT. For free education, check out his YouTube channel, The Inner Circle Trader. With that being said, this channel and video is for entertainment and my own learning purposes only. This is not financial or trading advice. Please trade at your own risk. Now, someone asked me, what makes a fair value gap or market structure shift valid? And the way that ICT explains it, um, it's very powerful after a run of liquidity. So let's say, for example, let's hop to, let's say for the 1 hour time frame, right? After a run of liquidity, let's say that there was liquidity. See how there was liquidity that was building up right here, liquidity building up right here, liquidity building up above these areas. And after a run of liquidity, ICT says, not always, but most of the time, price will run it and reject that area. So that's when you want to go in and look for a market structure shift. So like right here, it ran it. If you drop down to a lower time frame, you could look for a market structure shift. Now, again, what is a market structure shift? So the way that ICT puts it, there's a swing, right? So what makes a valid swing point? A valid swing point is whenever a candle has a wick, a longer wick, and then like those are terrible. And let me go ahead and just demonstrate right here, Raj. So if you notice right here, price created this wick, and this wick, right? But if you notice how this black candle's wick right here, this is the longest wick, it's the lowest wick. And this wick to the left and this wick to the right were both higher. They were both higher lows, right? So this wick was higher than this wick, and this wick was higher than this wick. This is a swing. Same right here. Boom, 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 right? See how this was lower than this and this was lower than this? This is a swing high. This is a swing low. So you want to pay attention to that after a run of liquidity. After that run of liquidity, you want to look, where's the most recent swing point? It was right here, right? Now, where's the most recent swing point after the run of liquidity? It's down here. Price comes down, and then it creates a new one. Boom, right here, right? Now, this is a market structure shift right here. As soon as this candle wicks it, it's very important, and ICT says this too, it's very important. It does not have to close below here. It can wick. It does not have to close, but this is a valid market structure shift point, right? And then it created a low right here. After this low, you could see that this was the market structure shift point for a high. It wanted to go back up, but then it created this one right here. Right after this low, this candle created the swing point, but it also created this one too. And then once price took this out, it's now going back up. So we want to look for that displacement, right? Because there was no displacement right here. That's why there was no fair value gaps here. That's why there was no entries here. Now, continues going up, right? And as you see, created another swing point right here. So if we just drag this one up, another swing point right here, right? And then price comes down, creates another swing point right here, right? Why? Because of this wick, and this wick. It's three candles, okay? This is the low. This is the new market structure shift point. This one closes, and this one closes. Once this one closes, it creates a new market structure shift point. You see that right here. Boom, right? Now, comes up, you can see that it takes out a little bit of liquidity right here. This is also considered liquidity. Any swing point above that, there are stop losses. Below that, there are stop losses. Any swing point that is created, it doesn't matter what time frame you're on. But liquidity, ICT says, is most powerful on the daily time frame. But you can see it on every single time frame. It's fractal. So notice right here, price shifted structure right here, and it had a nice displacement. You can see that this was like a displacing candle. There was a tiny little fair value gap within here. And you could have possibly taken an entry off of that. Now you would have got stopped out, but that's just, the realistic side of trading. You don't win every single time. You can be a terrible trader, but be a really good risk and money manager and still be profitable. If you're a great trader with terrible risk and money management, that's just a recipe for disaster. So work on your risk and money management, how you handle the trade while you're in the entry, how much you're risking, and if you're losing, if you're on a losing streak, are you going to cut loss? Are you going to stick to the same risk? Me personally, I like to cut loss, and so does ICT. He says, why would you keep risking 2% if you're on a losing streak? You're losing your ass off. Why are you going to continue to risk 2% when you should just cut your risk because you're losing confidence with every loss? Of course, you got to stick to the plan, stick to the routine, and just trade the setup. But why are you going to continue to put so much risk when you're not that confident, right? It just makes sense to cut your risk. But again, I'm getting off topic. Right here specifically, you would have lost, right? If you would have taken a sell right here and you would have had your stop loss above this candle. Why this candle? Well, I like to put my stop loss above the one candle of the 1, 2, 3 fair value gap pattern. But this candle was higher than this one. So I would put it above here, got wicked out, and that's totally fine. You know what I mean? Again, I'm not paying attention to time either. Now, if we applied time to this, it'd be a whole lot different. So right now, we're on Euro USD. So on Euro USD, you're going to be looking for setups within the time of 7 to 10. And that's specifically New York UTC -4. Again, I don't know if the UTC -4 is the same for everyone, but it's New York, okay? New York time, 7 to 10. Market 7 to 10. Look for that liquidity run. Where is liquidity prior to 7? There's liquidity right here. Boom. There's liquidity right here. Relative equal lows right here, right? Liquidity got ran. At that moment, you drop down 1 minute time frame. Right here. Just to be clear, y'all, I went over this in one of my previous videos. ICT says do this and in 90 days you can quit your fucking job. Right here, I am demonstrating it on Forex because in those videos I demonstrate it in indices. And everybody's like, can you do this in Forex? Yes, you can. And you can see it right here. We ran that liquidity. Sell side liquidity is ran. As soon as that is ran, we drop to the 1 minute. Where's the most recent market structure shift point? Well, if this is the point where liquidity ran, boom, right here, looking up, this is the most recent, right? Now it creates another one right here. So we move it down. Every time it creates a new swing point for a market structure shift, you want to mark that. Creates a new one right here. So we're going to move it down. Comes down, creates a new one right here. So we're going to move it down. And look at this. How beautiful. Right here, you can see that price. Market structure shifts with the big displacement candle. From that displacement low to the displacement high, do you see a fair value gap? Well, between these three candles right here, there's a huge gap right here, right? You could have taken that entry. Boom. You set your buy limit right here, and your stop loss goes below the one candle of the fair value gap pattern. This is a 3-pip stop loss. ICT says in that video, 5 handle stop loss. And at 5 handles profit, he's taking off half of his position. He's letting it run for the rest for opposing liquidity. This is less than a 5 handle stop loss, dude. So all of you people who are like, you're going to lose your ass off, not going to lose your ass off, because you can see right here, we won our ass a bunch of fucking money right here, dude. A 1 to 8R right here, Euro USD, April 5th, between 7 and 10. Go back test it. Go look at this same setup. Go see why this happened. It makes sense, y'all. It's all logic. After a run of liquidity, look for that market structure shift, but make sure you drop a time frame. Drop below. Specifically, like in like in like 4. So let's say like it's a 5-minute liquidity run. We drop to the 1 minute. So that's like 5 time frames down, right? That's 5 minutes down, right? Let's say that it's like a 1 hour time frame. Drop to like maybe a 15-minute and look for the liquidity run. But specifically, look for it. I like to look for it on the 5-minute to 1 minute. That's where you'll see this setup often. And it's not gonna happen every day, y'all. And it's not gonna be perfect every day, y'all. But keep that risk and money management in, like, keep it strict, disciplined, and make sure you keep the same setup every single day. Go check this out. Go back test it. Euro USD, April 5th, 2023. I'll catch you in the next video. Thank you for watching.